Hey everyone, today on the final bar, we'll talk about a market accelerating to the upside, bouncing off the 50-day moving average. As we talked about last week, and we had a bit of distribution, not a bit, but felt like a lot of distribution at the time. It was all right. It's all about now the lines in the sand. Our stocks, our charts able to hold those key lines of support. For the S&P, it's something like the 50-day moving average so far, in pretty impressive bounce off of that support level. And the question now is that the leading into the next bull leg higher, or a bounce before the next leg down? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together, focus on the message of the markets themselves, try to cut through the noise as much as possible, and focus on the trends. As I was telling viewers of Aaron Swanland's trading room this morning, I did the Decision Point live trading room. It was a lot of fun. We had a great time talking about a bunch of different charts, but I sort of explained that I think the goal of any technically oriented investor is identify trends, follow those trends, anticipate when the trends are exhausted. Those are the three things you should be trying to do or strive to do as a trend follower, as a momentum investor. And that's really the style of investing that we are generally advocating and talking through when we review the charts together. And what we've seen over the last couple of weeks, really year to date, is a market that is certainly in a bull market phase over the long term. And the question is all about the tactical side, the short term, right? At what point does the market exaggerate the uptrend, and when does it under exaggerate? When does it sort of overshoot it to the downside? And what's interesting right now is we look at some of the charts here on the macro level at sectors and then on individual stocks. Some individual stocks, I think, it's some really key levels to pay attention to. Those are the charts I'll be reflecting on this week. As a reminder, we have some great guests on our show. I'm so appreciative of the time we have with some of these top technical analysts. And this week, three of the street's really leading analysts. We have Jonathan Krinsky from Baycrest Partners. On Tuesday, Jeff Hughes from JWH Investments. On Wednesday, and then Thursday, Ari Wald, the technical analyst at Oppenheimer's. At Oppenheimer, these are three gentlemen who I'm very proud to consider peers. I've enjoyed getting to know them and their work in many of our years together, learning the technical toolkit and seeing them go on to great things. They're followed by a lot of institutions. We get to pick their brains on this show. Let's get to the market recap. So on Monday, we sort of have three pieces to the puzzle. First is macro perspective. What's the big picture? What are the overall charts telling us? Then it's sectors. What sector movements, themes can we tease out? And then third is individual stock selection, really focusing on which names are moving and where the opportunities may lie. Now, overall with the market today, S&P came off a bit just in the last hour, closing around 3,900. That's about 2.33% higher than it was on Monday's close, and Monday's certainly a choppy day in a distribution week. Last week was certainly the first sort of heavy distribution week that I've seen with 80-90% down days at times, and a lot of stocks sort of rotating lower. Our long-term trend following models, if you watch Friday's show, both the long-term remains positive, but the medium-term and short-term both turn negative on Friday. That's a weekly closing look that we do. We'll review them again next Friday, but as of last Friday, those both turned negative. So it suggests to me to be more cautious than anything and be on the lookout for breakdowns. We did not see many of those today. You saw a bounce off of the 50-day. Now, any technical analyst, anyone that looks at a lot of charts for a lot of years will tell you when you pull back to a 50-day moving average, you would be amazed if you didn't get a good bounce off of the 50-day because so many people are keying in on that key level. And so I'm not surprised that we had a good bounce today. It's all about the follow through. What does the remainder of this week look like? I could see one scenario where we just continue to move higher, and looking at some of the individual charts, they're decent trends, right? I mean, Gap, LB, Under Armour, Newell, Alta, Fox, Disney, Viacom, News Corp. I'm kind of randomly throwing charts on my list that we're going to look at later, but these are all stocks in established uptrends holding up beautifully. It's telling you that the trend is in good shape and there's nothing to worry about. So the question one is, we continue those trends, they continue higher. Option B, stocks like PayPal and others that have pulled back to a 50-day, semiconductors that are showing a bearish divergence. These stocks are unable to hold their moving averages. Apple recently oversold, continues to go lower. These are the things that would tell you, okay, this is the beginning of something much deeper. Either way, today makes sense. It's either a nice bounce off support, and then that was it, and all the buying that was just waiting for a dip is kind of in, and no one's left to push it higher. Or we do get some staying power, and we get further accumulation through the course of the week. I think it's going to be a crucial week to make sense of things. Mid caps and small caps both up even stronger. The S&P 600 up 3% today, which is a nice move higher, and the VIX now back nearing the 23 level. Bonds, move around a bit. Overall, finished lower. If you look at the TLT, 10-year yield sort of stabilizing overall. Precious metals down, base metals higher. So you had copper up and gold down, but gold and silver were essentially flat. Plenty of move higher on the crypto side, with Bitcoin up 7.5%. as of the close, reaching back up to the 49,000 handle. Looking at a daily chart of the S&P, let's start there, and then we'll look through some of the other macro charts as we can. Overall, as we've talked about last week, I think when you talk about the three goals of the individual investor, in my opinion, number one, identify trends, and there's no denying in my mind that the trend in stocks has been higher. We have models that we run to sort of track the overall trend and try to make it a little more systematic, try to take the guesswork out of it. But it's also just looking at some simple things like higher highs and higher lows, the Dow theory of a trend. What you've seen on the chart of the S&P really since October and November, when you broke out of that coil pattern, is a consistent pattern, relatively consistent pattern of higher highs and higher lows. You had a bit of a head fake there in January, and we pulled back to the 50-day. We made new all-time highs soon after. We now pulled back again to the 50-day, and as of today, a nice bounce off that key smoothing mechanism. That 50-day holds. That would be a pretty compelling long-term story, suggesting further strength, and in general, I think the trend is up until proven otherwise. What would be the multi-step breakdown process? It would be a breakdown through the first trend line, this pink trend line, which we did there at the end of January, retested it and rolled over. Step two, breakdown through the 50-day, which we have not done. We closed right at it on Friday and now have bounced off of it. And then step three would be getting below 3,700, which would be that swing low from January. So we've fulfilled one of the three steps, but certainly not all of them. And again, until proven otherwise, I think the trend is good. When I'm looking at individual stocks, I'm finding plenty of charts that look good. The question I have is, how do you balance? And I'm sorry, I'm totally jumping around, but that is how my brain is at the moment, trying to digest all these moves. On one hand, you have stocks like PayPal, which have pulled back. And if, I always tell people, don't, ignore what all is going on in the world and just focus on this particular chart. What does this chart tell you? And again, knowing nothing about what the market is doing overall, what's happening in the world, I'm seeing a chart that's been in a nice uptrend. I'm seeing a chart that's pulled back to an ascending 50-day moving average after coming out of an overbought condition. It's been a long-term relative performer. And overall, that's setting up pretty nicely for another like higher. That's the type of chart you would probably want to lean into. Now you have to balance that. What's something in sort of a good long-term uptrend? Oh, that's not my favorite, because that's actually a pretty good one. Maybe Discovery, right? I mean, let's go really crazy. Something like DISCA has been ripping to the upside. It's tempting to want to chase something like this, but I would argue it's probably not the best risk reward because it's had so much of a run. I'd much rather wait for some sort of actionable pullback. So, which of those is right? Are we looking at PayPal types of charts where we're pulling back to reasonable levels? This is a slow and steady uptrend. Or is this the most euphoric, out of control uptrend in history, and stocks are, really need to pull back and digest a little more? And maybe it's a little of both. Maybe some stocks need to correct a little bit. Maybe it's things that have been overheated, that have had these ridiculous runs that a lot of people have piled into, that need to come off. And maybe it's other names that are more emerging. And I sort of skipped over Alta. is one that's more of a slow and steady gainer, a nice performer. It's not really becoming overbought too much. It's just sort of a nice steady uptrend after breaking out of a long-term base. So I think, if you think of the market right now as all in or all out, I think it's going to be very difficult. If you look at individual stocks and look at the patterns and lean into patterns that you think have a high percentage of working, lean away from those that don't, I think overall you'll probably weather things pretty well. We need to just look at maybe one or two more charts. I mentioned with the chart of gold. Gold was down again a little bit today, but overall, I tweeted out earlier, life's too short to buy charts with I'm paraphrasing, to follow charts that are long-term underperformers. And if you look at gold relative to the S&P, it's long-term been underperforming. It's been in that downtrend for the last 6 months. And you see that on the XAU and the GDX, and obviously gold stocks as well. And again, I think we're nearing the point where gold makes sense as sort of a bottoming point. 1700 is a really good level. That's sort of the level from last spring where it found congestion. It was a congestion area. It's also a 61.8% retracement of the major of the recent rally. I think overall that could be a decent place, but until the trend turns higher, the trend is down. It's oversold right now, and I think as of today's close, it probably is completely oversold. So that's a chart I would certainly be watching to see if we're near an inflection point on something like gold. But I'm going to wait and see how the trends actually evolve. That is our market recap. We jumped around a bit. Sorry for that, but let's continue on with our sector setups, focusing on the 11 S&P sectors and the themes there. Looking at the weekly RRG, and if you're not familiar with this, Julius de Kempener, he shows Sector Spotlight, does a great job of featuring this methodology. I encourage you to check out his work. But essentially, we're looking at energy and financials, number one and number two. Clearly the leadership out of these 11 sectors, looking at the longer term time frame. That's where the trends have emerged and have continued. I think overall they set up beautifully. And when I look at some of the strongest charts in terms of charts that have improved and have broken out, but are not way overextended, where you like a discovery where you think, wow, there's that's ridiculous how high that's gone so quickly. You're not seeing that in a lot of energy stocks. You're seeing more established trends that are now continuing. And if you measure the height of the bases, they measure a lot higher than where they're at right now. So those two sectors, I think from a technical perspective, very much justified. And I could see those trends continuing. Sort of the next tier, the second tier down, would be communication services and technology as a whole. Not nearly as impressive on the long term, but you're seeing some interesting charts out of there. And again, I'm thinking of the media names, video game stocks within communication services, actually pretty interesting. The problem and the reason why communication services doesn't look as good is some of the largest stocks in there, things like Facebook, Alphabet, not nearly as good. And we'll look at those here in a moment when we get to our shifting stocks segment. So overall, I think the two outliers in terms of strength, energy, financials, that next tier down where I think you need to be a little more opportunistic in terms of what stocks within those sectors are working, communication services and consumer discretionary. I think those are decent. It's the largest stocks in those sectors that are struggling at the moment. Looking at the 11 S&P sectors through this lens, using the candle glance page, it's worth paying attention when the market's choppy like it was last week, how many of these sectors remain above their 50-day moving average. I'm seeing consumer discretionary rotated back below there, sort of just teasing it from below. So maybe too early to declare that completely broken, but it certainly broke down through it last week. Staples have been below it, their 50-day for a little while. Healthcare has now rotated below its 50-day moving average. Utilities is back below there. The rest of them remain above. And, when I'm thinking of what differentiates a market that is in correction mode versus healthy pullback mode, it's things like this. Do sectors and stocks hold their 50-day moving average? The XLK, as of today, appears to be bouncing right back above it. On Friday, it did not look as attractive. When I'm making notes over the weekend, I'm looking, this is really close. I could see Monday turning into a very sad technical story as things start to break support levels. But so far, nice bounce off the 50-day. And then it's looking to the left and seeing if we're able to hold the most recent support level. And that's the low there on 128 on the XLK. Charts like this that hold the 50-day, very encouraging for the overall market. Charts like this that fail at the 50-day and break their most recent swing low, that starts to look really negative. And the problem with that, I think, is with the influx of a lot of investors that have not really seen a meaningful downturn there's a lot of euphoria and a lot of buying that's happened. I think there could also be desperation very quickly, panic selling when things roll over and we find that things don't go up all the time, that they start to come off. So now when things are holding, when things are doing okay, is the time when I would be clearly defining my risk and thinking about potential downside on positions that you own. I mentioned this last week, and I went on Bloomberg TV on Wednesday, I want to say, and this was a chart that we talked about, and I think this chart will be featured in future textbooks on technical analysis for one of two reasons. Either it is the most, it is such a clear example of a bearish divergence of a market going higher on weaker momentum, and your technical analysis book will tell you you should be selling that type of pattern, or at the very least leaning away from that, lightening up on it, because it tells you the price is going higher, the momentum's coming out of that trade. So here's the thing. It's going to be featured in future textbooks, either because it works perfectly and the SMH semiconductors break down through their 50-day breaks through 225 on the SMH, and this rotates lower, and it's looking back, you will think that was the most obvious example of a market exhaustion. Option B, though, is this fails colossally and it goes to new highs, which I could certainly see happening. And then it's a reminder of how bearish divergences are not 100% accurate. They sort of signal 300% of the tops, and that's a tongue-in-cheek way of saying you get a lot of false positives, right? You get a signal that things are rolling over, but the market continues higher. You saw that with Tesla when it continued to get bearish divergences, but then would just blow right through that and go higher. But the problem is you also see it on times like January and February of 2020, classic similar pattern of higher highs, breaking to new highs, but the momentum starts coming off, and that's before, more of a deeper corrective pattern. So, again, I'm looking at that chart to see whether or not we get the follow through to the downside that the chart would usually warrant, or if bearish divergences like that come and go and the market keeps going higher, that really speaks to the resilience of the trend. Regardless of what you think may happen, I would be focusing on the trend itself. Higher highs, higher lows is an uptrend. We need to take a quick commercial break. We'll be back with my next segment, Shifting Stocks. See you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close as we try to make sense of these markets using the charts. As a reminder, we'll do another mailbag segment on tomorrow's show. You can get your questions to us. Nothing is out of bounds via email, thefinalbar@StockCharts.com, on Twitter @FinalBarSCTV, or on our YouTube channel. Just put a comment below the video that you're watching. We'd love to answer one of your questions on the air. Also, as a reminder, you now have 3 ways to consume all the goodness on Stock Charts TV. Number 1, on our live stream, which is StockCharts.com/TV. That is our live broadcast, runs 24/7. Option B, our YouTube channel, which has a ton of good content on there, and make sure you subscribe to that. And then number 3, our new on-demand platform, StockChartsTV.com. Just look at the Stock Charts TV app in any app stores. You can create a free account, get all of our content right there as well. Our final segment today is called Shifting Stocks. So we've talked about the big picture, the resilience of the S&P bouncing off its 50-day moving average, weakness in gold. We didn't talk a ton about commodities, but certainly taking a breather, a well-deserved break after an extended run to the upside. Talking about sectors, it's the continued strength in energy, financials, but also places like industrials, materials with some decent charts, and the individual sector ETFs holding up very well. Opportunistic within things like communication services. And let's start there as we go to our final segment, Shifting Stocks. Zoom just reported earnings after the close here. I think it's worth paying attention. The stock was up almost 10% today. This is bouncing off of its 200-day moving average. Compared to other charts out there, it's not the best chart, only because other things are in stronger uptrends. This essentially hit an all-time high in October and has been in downtrend mode since then overall, right? It's overall making lower highs and lower lows, but now it's pulled back to its 200-day moving average. It's remaining above its low from January. This could be an attractive risk reward here. Now, obviously, it's beaten earnings today. This is after jumping up pretty good, but a good stock that does well over the long term still could be a very decent entry point to ride this higher. I think breaking above 450, we'll see where it goes tomorrow after the open. But overall, I think at the very least, a break above 450 is really completing a rotation back to bullish mode. It could be a really interesting long-term story coming off of its 200-day moving average. Now, elsewhere in communication services, you have kind of a mixed bag. We talked about Discovery, which I think is super extended. That concerns me a little bit. I'm looking at other charts that are less extended, and I think, when I think about a market right now, when I'm looking at a chart like Discovery, it's one of those. If you bought it a while ago and you still hold it, I think that's great. Would I chase it today? Probably not, because it continues to just go vertical. I think those are dangerous trends to necessarily want to go into. You want to wait for some sort of opportunity, some sort of pullback that indicates a bit of profit taking, and you can get in at a more reasonable level. Something like 21st Century Fox is a little more slow and steady on a relative basis. Hasn't been a huge relative winner, but it's been outperforming overall for the last 2 months. And look at the trend is rotated from consolidation phase to accumulation phase. I like something like that is not overbought compared to things that are more extended. So I'd be looking for things that are a little earlier on in the trend. Disney's an interesting one as well, and I think looking at something like Disney, the balance is, do you continue this uptrend? Do you continue the stretch of relative performance, having a clear divergence, which is the same issue I have with semiconductors and many others, where the chart looks good, but I'm seeing weakening momentum overall? Given, what am I going to believe? I'm going to believe price. And as long as price keeps going higher, most recently, it's continued to make higher highs and higher lows. Overall, I see that as a decent trend with potential to go higher. Things like Activision pulling back to an ascending 50-day moving average. There's a bucket of stocks, Activision, PayPal, others that I'll try to get to as many as I can, that are pulling back to their 50-day. I think it's a really interesting time to run that screen using the scanning engine and see what sort of names pop up there. ATVI is potentially a really interesting setup, higher highs, higher lows, and now pulling back to the 50-day. Again, a chart like this works. That makes sense to me as a technical analyst. That's a pretty high percentage sort of chart to be looking at. These sort of charts fail, and I would start to get really uncomfortable very quickly with the overall market environment. Now, why is communication services as a whole not raging to the upturn with those kind of charts in there? It's because some of the biggest stocks are struggling. Now, Facebook was up almost 3% today. That's great, but it still is not performing well on a relative basis, and on an absolute basis, it's at the lower end of the range that it's been for the last 6 months. The other big cap or mega cap name in here is Alphabet, which is a little more constructive, right? So here you can see a little more of a breakout story pulling back to 2000, and big round numbers like 2000 tend to be really meaningful on a chart like Alphabet. Look back when it first hit 1000 and you'll see what I mean. I would see to whether or not this is able to hold that 2000 level as it pulls back and digests those new highs from mid-February. Looking at consumer discretionary, this is one of the charts we featured last week on Friday, if I remember right, the iBuy, which is one of the e-commerce ETFs, and one of the stocks in there, I would assume, would be PayPal. This is another one like Activision, sort of pulling back to an opportunistic level, arguably. RSI just above 40, pulling back to an ascending 50-day moving average within a long-term uptrend. Overall, it's actually a pretty decent chart to be paying attention to. I'm also looking at things like Under Armour, which again are not as overextended, but are sort of in nice uptrends. Newell NWL is similar, sort of pulling back to its 50-day. These are some of the ones that came up on that, looking through and looking for stocks pulling back to a 50-day moving average. Could be an interesting one to pay attention to. The other one I would say within consumer discretionary of many to pay attention to is Best Buy. Big round numbers are always fascinating. There's been academic research that shows how stocks tend to do things around big round numbers. It's a psychological thing. When a stock goes from a 2-digit stock to a 3-digit stock, it has meaning. And so pulling back to 100, the question is Best Buy a $100+ stock, or is in the 90s or lower? And it's held 100 a number of times in December, and now once again pulling back to that level. So while the trend overall is not as positive, it's oversold right as it hits that key round number. And I'd be very keen to know whether or not that's able to hold. What else to pay attention to in consumer discretionary, just to finish off that sector? Nike might be another one. This is, Etsy was a similar sort of pattern. You had something that's had a nice run and is now in this consolidation pattern, lower highs, higher lows. Which way does that break? Either it breaks below 130 or it breaks 145 to the upside on its way to new highs. I would expect whichever way it breaks, that's usually the direction of momentum. That's the way you want to follow things. Now, consumer discretion does not all look awesome. Something like Dollar General is probably a bit of a concern, and in general stocks where this is what the relative line looks like, you will not hear me be propping those up too much, only because I in general, you want to own stocks where the relative strength line is going up, not going down. Gold is a great example of that, GDX. However, what's interesting on the chart of Dollar General and some of these dollar stores, you actually have a bullish divergence right now with lower lows in price and higher lows in RSI. So it'll be interesting to see if you get a mean reversion, some of these bearish divergences rolling over and a bullish divergence like Dollar General breaking higher. That's why it's an interesting chart to watch for me. Consumer staples, I'd in general be leaning away from, only because there are a lot of charts that look kind of like GIS. And those are not the kind of charts in general I would ever want to be looking at, because it's in an established downtrend and it's a long-term underperformer. Those are not the types of charts that I would look at. But if you are compelled to go in there, remember there are charts that look a lot more constructive, and the tobacco names might fit that bill. These are higher dividend paying stocks and things that are breaking out of basis. So I like Mo sort of breaking above that 43 level. That's an interesting sort of cup and handle pattern, breaking out to new highs. Interesting to see if that's able to hold higher. We're out of time, so I just have to show one more chart, and probably I should stop, but I'll show one more. Within healthcare, Regeneron is one that popped up for me. It's oversold right now, and I think it's an interesting one because it's been, again, in an established downtrend. I'm not a fan of a lot of these biotech names that have been rolling over, and this is as other sectors, other stocks, industrials, consumer, and others just have had much nicer runs. This is something in a confirmed downtrend, but it's oversold, and it's had a pretty good move to the downside. You want to see if this thing is able to roll higher, make a higher low, and also break above trendline resistance. If you draw a trend line using these highs, stocks like this breaking that trend line would indicate that maybe biotechs as a whole are starting to appreciate a little more. But Regeneron overall, dangerous chart in an established downtrend. That's all the time we have for the individual stocks. Let's wrap the show. The 3 and 3, 3 charts, 3 minutes. Here we go. Chart number 1 is the DBC, the commodity index. There are a couple different ways to look at commodity prices. DBC and GCC are two of my favorites. GCC is an equal weighted, more equally distributed commodity. So it kind of takes the energy overweight out of that. The DBC has a big exposure to crude oil. It's a big part of that index. And you can see coming off all-time highs, long-term highs, not all-time, but long-time highs, but rolling over on Friday into today. So a well-deserved pullback. This is coming off of an RSI above 85. So it's totally reasonable that you would have a pullback within an uptrend. The question is it this sort of pullback, sort of that tactical pullback before we break to new highs, or does it go deeper? The problem on commodities is the 50-day moving average is really far away. It's all the way down at 1550. It's another whole point away from where we're at right now. Chart number 2 is the industrial sector. We talked about a lot of different individual names. We talked about some of the sector themes. Something like industrials is doing pretty well, and I think there's some decent charts in there. Infrastructure plays, something like Deere comes to mind. It's just a nice, solid uptrend. So I think if you're looking for stocks with good uptrends in good trend phases, I think in industrials you're going to find some of them. The XLI is one that's threatening a new closing high today. Finally, chart number 3, something like Regeneron in general is a chart that I tend to lean away from because I'd much rather own charts that are going up than those that are going down. But I'm always thinking, I always call it a bottom fishing candidate, something that's pulled back about enough that you might think it may be time to nibble on it. What's compelling about the Regeneron chart is 420 is an interesting support level. That's the 61.8% retracement level, and it lines up with the March lows, sort of this congestion phase there, which is why it's of interest. The RSI is just oversold, which is where it's been at previous times before it's had a nice bounce. Overall, though, you'd love to see this relative strength line roll higher, and you certainly haven't seen that yet. So Regeneron is sort of on my list of interesting, charts that have been in downtrends that may be nearing an actionable point. But overall, I'm much more looking at things like PayPal and others that are pulling back to ascending 50-day moving averages. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the final bar. As a reminder, go to StockChartsTV.com, set up a free account, check out all of our content on there on all of your devices. It's beautifully done. Super proud to present it to you. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.